Our guest today on the Clifford Chance Private Capital podcast is Frank Danieli, who's head of Global Credit Solutions at MA Financial Group, one of Australia's leading alternative asset managers. Frank is responsible for MA Financial's Global Credit Solutions platform, which invests across asset-backed lending, corporate debt, and specialty credit verticals. He holds degrees in commerce and law from the University of Sydney and has a professional background in strategy consulting and financial advisory, including restructuring. Frank, it's great to have you on the podcast. Thanks for joining today. To kick things off, could you tell us a little bit about MA Financial and your role there?
Thanks, David. Good to be here. So, MA Financial Group, we're an alternative asset manager listed on the ASX. We manage about $15 billion of alternative assets, but mainly focus on credit and real estate. In addition to that, we operate what we call a lending ecosystem, which is a very scaled platform associated with the world of lending. It includes a financial infrastructure business, Finsure, with about $179 billion of managed loans on platform, and our non-bank lending franchise that includes our MA Money business with now over $7 billion of loans. In addition to that, we also have where MA started, the Moelis Australia corporate advisory business.
You started your career at MA Financial in advisory, restructuring advisory principally, and then you transitioned into the private credit business from there. Could you talk a bit about that?
Yeah. In fact, I started on what I call the dark side of credit. So I was, as you say, David, a restructuring investment banker. And what that means is advising special situations, hedge funds and companies, as well as sometimes banks, where they're in a situation where there's a debt gone wrong. Could be a good company with a bad balance sheet. It could just be something's changed in a particular industry. But the point is the balance sheet needs to be recapitalized, and your job is to fix it. I know we worked on many transactions together back in the day. And so having done that, especially in the post-financial crisis era, we were really front and center to changes that were happening in the credit markets generally. And so going back now about a decade, what we did was to build a credit asset management business to capitalize on what we saw was some major thematic changes around the way lending would be done going forward. So today I'm head of what we call our Global Credit Solutions business, which is our private credit lending business, and have really built that up from the start. But it all began from working on the other side, from being in the dark side of credit. Today, my job is never to be there again. It's to write loans that hopefully don't go through distress or workout, or at least that it's a very low chance they do. And when they do, it's a small problem. So it's using a lot of the learnings from workouts and applying them in the normal performing lending business.
Can you talk a little bit about how you actually applied those learnings in your new role?
Yeah. So, our philosophy in private credit is about avoiding losers, not picking winners.
Yeah.
We're not trying to find the best loans out there in the world that could ever be done. What we're trying to do is to have a very rigorous process to filter out things that don't work, that put you in a problem situation. And to make sure that when we're writing loans and managing our portfolio, that we put ourselves in a good position, because inevitably the world changes. Sometimes the world goes through cycles. Sometimes there's structural changes in markets. Sometimes low probability events actually just occur. And when they do, you want to make sure, if you're a lender, that you've got good security, good asset backing, other defensive features, so you can go in and get either all your money back ideally, or as much as your money back as possible. So the learnings from a workout have really been foundational to how we approach the credit business, and how we designed our process of lending to make sure that we can deliver on our goal, which is really just consistent income through cycles, keeping people's capital as safe as we can, and trying to deliver them a premium in fixed income compared to what they could get if they just invested in bonds, which is the traditional way in someone's portfolio they get access to income and yield.
And so there might be some bets that make sense as an equity investor, but don't make sense as a private credit investor. Is that right? You're essentially not looking for significant upside, you're looking to minimize your downside risk.
Exactly. In fact, in our business, when we make a loan, as you know, we contractually agree with the borrower they're going to pay us an interest rate, and they've got to pay us back out the principal on that loan or on certain terms. That's all we get. If that company goes up 10x in value, I mean, our loan perhaps goes down in risk, but other than that, we don't get more. We just get what was agreed. And so we need to make sure that we are minimizing the chance we can lose on one loan. But more important than that, in credit, whether you're doing bonds or private credit, it really highlights something that's very important about the world of investing, which is it's not just the investments themselves. Most of the alpha actually comes from how you run your portfolio and how you manage risk. You got to make the right positions, the right loans in the first place. You have to have a really good portfolio construction, set of principles and governance frameworks around that. And then you have to be very attuned to what's happening from a risk perspective in your portfolio and how that's evolved and changing through time, how you're managing it. Um, that really is a different way of thinking. If you compare it to, say, an equities portfolio, I know personally, in personal portfolio, sometimes invest in equities or with equity fund managers. In equities, you can have a concentrated portfolio of, say, 10 or 20 of the best companies in the world that can deliver long-term compound growth.
Yeah.
And if one or two of them don't work out, it sometimes doesn't matter because the others can make up for that. It's not like that in credit unless you've got very good diversification, low correlation, and thought very carefully about how you're building your book.
Mm. When you think about alpha or you're trying to achieve alpha, is there ever an equity component to it through warrants, for example, or are you purely lending?
There's lots of different brands of private credit. The brand of private credit that we're very focused on today, it's about 97% of our AUM is in this form of private credit. We call it a fixed income replacement. And so that is, again, trying to deliver what people used to get in a bond portfolio, but where they might say, look, for one part, let's say I've got the old 60-40 portfolio and the 40% is the defensive assets there to protect me. What we're saying is, look, how much of that 40% do you need daily liquidity from, say, bonds? Or how much of it can you trade off liquidity to get a premium? And what we're trying to do is deliver that premium with a consistent risk framework overall. So the alpha we're looking for is not trying to say we want all our loans to be these top quartile loans and deliver 15%, we're going to get there with debt warrants, this, that. We're trying to actually say, what's the true risk characteristics of this position, this loan? What would it give me in the public markets? If I'm doing this in a proprietary private sense, what premium do I need to earn to do that? And that premium is probably 200 or 250 basis points, so 2.5 percentage points. Which in the world of fixed income, that's actually a lot. So it's basically the difference between maybe earning 5 or 6% in bonds and earning 8 or today in this interest rate environment around an 8 or 9% return.
Yeah. I think as an investor, I like that because I know what it is that I'm investing in. I know that 8% is referable to an actual claimable debt rather than it being supplemented by a riskier product. Is that feedback that you hear from your investors?
We do. And on the point of knowing the risk profile of what's in the tin, that's a pretty important principle that's evolving in this space as well, which is that in private credit, the loans aren't traded out there in the market. They are generally proprietary oriented loans. And so from a fund manager perspective, giving your investors good disclosure and transparency, not just about what's in your portfolio. That's a very basic level of transparency, but the risk characteristics of it, where the risk adjusted returns are actually coming from, as well as the governance environment in which you're actually running the money. How are you doing what you're doing? Where are these returns really coming from? That's becoming more and more important, and we're certainly seeing investors demand more of that, which is a great thing for the industry, and we're very much pushing for that.
Yeah. MA Financial's grown a lot, and your part of that business has grown a lot. How do you manage risk across a much larger pool of assets?
Yes, that is Right. And that's a general problem in credit. The thing about credit is that it's actually really easy to grow. If you drop your underwriting standards and you lend on a loose basis, borrowers will find you. So you can put money out and put it to work. The key thing is not putting money to work. The key thing is putting money to work on good terms where you're going to get your money back and you're going to get your interest along the way.
Yeah.
High probability. That part's really hard. It's hard on an isolated basis for one loan. It's certainly hard as you grow. What we think you need to do this well is you need to have the right universe of addressable opportunities so that you can be very selective. Now, that means you can't just do one thing. You can't be what we call monoline. We lend across our platform into asset-backed lending verticals, which is basically large portfolios of traditional and specialty loans. Direct asset lendings, where we're senior secured lender secured by physical assets, and to corporate loans, both sponsor and non-sponsor backed. That's a wide ambit. A lot of managers will just do one very narrow thing. And the moral hazard of that is that at some point in the cycle, it's not optimal to put your next loan in that sector. You need to pivot. But if you're only running a fund that just does one thing, are you really going to call up your clients and say, you know what, David, have the money back? Or don't, it's best you go elsewhere. Of course, you're not going to do that. You're in the business of charging fees on capital.
Yep.
So we think you need this really wide ambit. You need an ecosystem of proprietary origination where you're seeing lots and lots of deal flow. And we've invested very heavily in building that. That's why at the outset I said at MA, not only do we have the funds management business with a large experienced team, lots of relationships in the market, but we also benefit from the broader MA platform, our non-bank lending platforms, our FinSure ecosystem infrastructure, which, as I said, has over $180 billion of managed loans on the platform. A lot of data and intelligence about the market, touches 350,000 customers. And we do these, in addition to that, strategic partnerships with banks and non-banks to give us exclusive access to deal flow. So we've built this funnel. It's been a long journey, but the funnel allows us to see tens of billions of dollars a year of lending opportunities. And then we can filter that out to maybe 5 to 10% of that opportunity set that we actually want to do. And the key as you're growing is making sure you're investing in that source of origination. You still need to have good credit process for when the loans come in to filter them properly. And I think the other thing that you really need to do to demonstrate to your clients that you're operating with the right set of standards is that you need to be aligned. The way we're aligned is that not only have we invested capital in building that ecosystem, we actually are significant investors in the funds ourselves. Today at MA, we have, I think the figure's about $240 million invested by the firm and staff in our credit funds alongside our clients. And that ethos of being aligned, being at, we call it co-creative value, co-investing with clients, it's not just the firm's balance sheet and a few senior people, it's actually widespread. We have structures to encourage people to be participating in these funds. So when they're making their day-to-day decisions, they're doing it not only as a manager, but as an investor too.
When you're constructing, say, a wholesale fund, would the credit within that fund be referable to the different verticals that you spoke about? So there might be some real estate credits and corporate loans, or do you have separate funds for different kinds of debt?
For what we call our flags, it is both. For our flagship vehicles, and some of our funds are public. It's easy to talk about. We have some listed funds actually listed on the ASX, which are easy to talk about because they're out there, MA1 and MA2. These vehicles, these flagship funds, they have lots of things within them. MA1 is across all those verticals of lending. It has today 245 positions within it, it's over $7 billion in terms of the underlying portfolio there. So it's across lots of different things. And the idea of that is that it's almost like a one-stop shop for people to be able to say, okay, here's a participation, a broad-based portfolio. I think for most investors, honestly, whether it was an institutional investor, a high net worth or family office wholesale investor, or even a retail investor via a wealth platform or something like that, I actually think that model is the better model, because it really leans into this idea that private credit is not trying to get equity returns through the debt or something very nuanced and crazy. It's actually a fixed income replacement product. And that's what fixed income is. You wouldn't invest in a bond fund that just said, I only buy the bonds of CBA, or at least I certainly would do. Not that CBA bonds are bad. They're, it's one of the best capitalized banks in the world, but you want diversification.
Diversify.
It's not there for growth. Do that in your equity portfolio. That said, for certain institutional clients or very sophisticated clients, uh, we sometimes do offer those more bespoke strategies, but for the vast majority of clients, I actually think the broad-based strategy is better.
And when you're making a real estate loan compared to, say, a corporate loan, the process of assessing and pricing risk, is that quite a different exercise? And do you have specialists in those different verticals that price that risk?
We do. In each vertical, you need specialists who are across the intricacies of the structures, the underlying asset classes, of course. The principles of credit don't change that much. I think about them very much through the analogy of your checklists. And the checklists are really, what are all the things that we've observed that correlate with credit going wrong? And are they in place? So in our checklist, we have things that come up as amber flags, red flags, and bright lines. The bright lines are, we just can't do them. We don't do the bright line things. But sometimes a red or an amber flag, depending on the circumstance, you might sort of a deal, but it's a signifier of risk. The point of the whole of the
Sorry, is that about the structure of the loan or the nature of the borrower, or can it be about both?
It's about both those things. It's really about three things. So we think about it through the lens of credit risk, structure risk, and fraud risk. Credit risk is to be managed. It's the qualitative and quantitative factors of credit. What's basically the probability you're going to get paid back, and the downside risk if you don't. The structure is there to be controlled. That is to say, the structure of the loan should give you proper exposure to the credit. If it's got holes in it, you might have that structure pulled apart, and even though the credit performs, you don't really get the benefit. That's not a great scenario. So the structure is there to protect you. It's also there to make sure that you've got the right leverage vis-a-vis the borrower. That is, you're the lender. And the principles of a capital structure is the lender has a capped return, their interest rate, but they also get their money first. Equities loses first, and you need to make sure those principles are in place. The final risk of fraud risk, fraud is a spectrum. Fraud is a spectrum of egregious behavior, someone actually making up financials or making up assets. And unfortunately, out there in the world, that does happen. There's a couple of high-profile examples that occurred last year globally where some very brand name banks and institutions got exposed. But the spectrum goes from that egregious, which you simply must avoid and look for the red flags to avoid them, to misrepresentation, overstating earnings, representing things to be rosier than they actually are, things like that. So you got to look for those things. So our checklist processes are about making sure that we're in each of those elements of risk, that we're not doing things that would put us in a really difficult position that we should have avoided.
How do you, those checklists must have been built up over time. How do you capture the learnings within an organization that's growing so quickly?
Yeah, they've been built up over time, not only through the work we've done in the credit business itself, but also through the experience of the team members. Beyond that, we actually just spend a lot of time studying examples of credit gone wrong, even when they don't relate to us. If you were to go and ask one of the associates at MA in our credit team, and you said, what was the first AAA securitization to default? I hope they'd be able to tell you it was Healy Myers in 2000, and what happened was XYZ. And the check we have for that is this. And that's because we talk about these things. We often talk about the lessons that we learned in some of the restructures that we did. What actually went wrong with Bought Longyear? What was wrong with that capital structure? Villabond, Centro Properties Group, what were the learnings from this, and how can we apply that in other areas? And so it has to evolve. It has to evolve for what you see out there in the market as well. Today, obviously, one of the big risks is around AI disruption. And so that was something that 10 years ago we started the credit business. That wasn't on, we weren't thinking about it anyway. and that has evolved. So I'm sure in another 5 years there'll be many more things we add to the checklist.
That concludes part one of our conversation with Frank Danieli of MA Financial. Please join us next time as we dive into the remainder of our conversation with Frank.